Today is the ABCs of hard money lending. My name is Conor Reilly. I am with Washington Capital Partners. We're a hard money lender out of the Mid-Atlantic area. My office is in Northern Virginia. However, we are heavily involved in the Philadelphia area. I've been a part of this grid for a couple months now, working with Matt Greene and Todd Miller. Todd is on the call. Matt has been unable to make it today. So those are your local subject matter experts. Todd is an amazing resource for rental property questions and renovations. Matt is a very, very strong agent in the area who's very quick to be able to run comparables for you. So if anyone is looking for an investor-friendly agent or just has questions about the market in general, Matt can help you out there. So this is Grid Philadelphia, ABC's of hard money lending. Now, before we begin, there is always a disclaimer. I am not a tax accountant. I am not an accountant by any means. I am not an attorney. In fact, I am not an agent myself. I am a hard money lender. Anything that we provide today is for educational purposes and the matter of opinion. If you are looking for true legal guidance, contact your attorney or your accountant for any items that you may need. So to start, what is a hard money lender? A hard money lender, they are a source of funds between a banking institution and a true private lender. Now, a private lender is going to be that rich uncle or friend who can wire you the money needed without much information. Now, that banking institution, they're going to offer lower rates, in the 5s or 6s now. They're generally going to require more cash to close, but it's going to be a much slower close. A hard money lender fills that gap between, that particular wealthy individual and the banking institution because we require less documents. Our rates are going to be a little bit higher than a bank. However, we can close much, much faster. That's really why, investors use a hard money lender to close in, 5 to 7 days. Hard money lenders are asset-based lenders. And what that means is that first and foremost, we're going to look at the numbers of the property to ensure that the deal makes sense. Following that, they would look at the client's profile, such as experience with deals of that type and the credit score. So if you hear the term ABL, that stands for asset-based lending. The deal and the numbers itself are what is most important. An example of that for me as a lender is, let's say that you're a repeat client and we've done 10, 15 deals together. I'm still going to look at that new deal that you're sending over to me. And if it doesn't make sense, I'm going to say no because the asset itself is what's most important over the profile of the client. Typically, a hard money lender charges interest on an interest-only basis. What this means is that you're not paying down the principal during the life of the loan. For those that own a home, you'd understand, with a fixed rate mortgage on a 30-year, your monthly payment goes to pay down the principal and interest. But because a hard money lender are typically shorter terms, and the reason for getting those shorter terms is because you're going to turn around and sell the property very quickly or refinance it really quickly. All you have to do is make those interest-only payments. You'll see hard money lenders offer terms of 3, 6, 12, 18, or occasionally 24 months. So it's what's called a bridge loan. It's a smaller loan that's not a 30-year term. Very, very quick turnaround time. At Washington Capital Partners, all of our bridge loans are 12-month terms, no questions asked. Any questions on what we've covered here? This is a very high level of just what a hard money lender is.
No.
Awesome. Appreciate that, Sherelle. Now, how do hard money lenders evaluate deals? Typically, they utilize 2 different metrics when they're going to be underwriting and evaluating and structuring a deal. There's LTV, which is the loan to value. Your lender likely won't lend over 70 or 65% of the potential completed value of the property. Meaning, if you have a property that you feel is going to sell for $1 million, they likely will not offer you a loan over 700 grand or 650 grand, depending on the deal itself. That is your ARV LTV, your after repaired value loan to value. The other acronym and numbers to consider, which are very big in the hard money lending space, is what's called LTC, or loan to cost. Now, this is something that's a little bit more new to the space and new to a lot of investors, but this is the number, this is the calculation that everyone really needs to understand and put a stamp on that they're comfortable calculating themselves. What loan to cost is it's the hard project cost of the deal itself. This is the purchase price plus the construction cost. That is your total project cost. A hard money lender is typically going to offer a percentage of that value. At WCP, we offer anywhere from 75 to 85% of the total project cost. Now, you may ask, what's the difference? Where does that difference come from? That would be your down payment. So if I was offering an 80% total project cost deal, you would have to bring 20% of the total project cost to the table. Typically, a hard money lender is going to offer you a loan amount at the lower of those two values. Now, if at any point your total project cost loan amount is higher than that 70% LTV or 65% LTV, it's likely not a deal that you want to move forward with because there's not enough meat on the bones to make sure that you're going to have an ROI that's worth taking that risk for. When a hard money lender is evaluating a deal, they're going to be underwriting it to their standards. They're going to be pulling their own comparables for the as-is value of the property, along with the after-repaired value of the property. The as-is value is important because we want to make sure that you're not overpaying for a property. For example, let's say that you were about to purchase property for 400 grand. However, within a mile of that property, there is no as-is comparable properties that sold for over 250. Why are you overpaying for that? Those are questions that they'll ask. A hard money lender is typically going to underwrite a property pretty conservatively and not look to hit top of the market on the out sales. What that means for you is that a lender is typically protecting you to make sure that your deal is going to be profitable and work. Now, that doesn't mean that when the construction project is finished and the things are all said and done, that you won't be able to hit top of market. However, as a lender, we're going to be more on the safe side and say, hey, at this number, we're very, very comfortable. You can sell for more if you would like to. Any questions on this, on how a lender would evaluate a deal?
No.
Awesome. Yeah, this is the time to ask questions. This is typically where we see a lot of different variations with other hard money lenders and ourselves. There's just little nuances when working with different companies, but I'm working to do the best that I can to encompass things from a generality rather than just what WCP does. What type of documents are needed to work with a hard money lender? Typically, they're going to see things broken down into 3 different categories. There's going to be the entity documents. This is going to include the articles of organization, operating agreement, certificate of good standing. An operating agreement really only needed if you have multiple members. If you are a singular sole purpose entity and a sole owner entity, there is no operating agreement needed. If you are thinking about considering of opening your own entity, I recommend not using Zoom Info. The reason behind that is because that's an expensive feature, expensive service for something that you can go onto your local Philadelphia SCC website and create the entity yourself. Additionally, You're going to want to talk to your attorney after I say this. However, if you're looking for a particular type of protection from an entity, you're going to want to look at more so creating an Inc. rather than an LLC. An Inc. you'll find offers more protection from lawsuits and stuff than an LLC does. Again, that is not advice, just something that I've seen in the past. Other items are going to include personal documents, such as personal financial statements, your track record. If you're brand new, understand there is none. If you have a track record of rental properties or fix and flips, you're going to want to have those ready and prepared. You're going to want to include items on that track record, such as purchase date, purchase price, the construction cost that you put into it, and what you sold it for. Or if you held it as a rental, what is the current lease on that? What's the current lease amount? And what's the current debt amount? You're going to want to show what you've been able to accomplish. This is your resume within real estate. There's going to be liquidity requirements. So you're going to have to show what your cash is in the bank. Most hard money lenders like to see true cash in a checking or savings account and not a 401k. So you may have to liquidate that. Although we are asset-based lenders, we still do check credit scores. We want to make sure that you are making your payments. However, most of these loans are not going to go against your credit. The reason being is because I'm lending to the entity. I'm not lending to you as the individual. A background check. Now, a credit and background check, these are items that will be pulled by the lender themselves based on their underwriting requirements. And lastly, there's going to be property documents. This is going to include the purchase contract, the construction budget, an appraisal if required, photos, all of those things that are particular to the deal itself. Now, when you're looking to work with a lender, whether it's myself or someone else, I highly recommend getting them over your entity and your personal documents, but not having that credit score pulled. Because if they have, let's call it 70% of their required documents to close from the entity and personal, you're going to be able to move along much, much faster. Questions on documents, why we collect them or what they mean. We do collect 2 years of tax returns. That is more so an underwriting requirement, and we don't utilize them to underwrite deals. So we're not evaluating DTI or debt to income. All right. How does a hard money lender work? Hard money lender works by utilizing the loan to cost. The lender will offer a loan amount and estimate the cash to close. Again, this brings me back to that 80% of the loan to cost. You'd have to bring the 20% plus the closing costs. High level, after the closing, the lender is going to release construction draws to you on a reimbursement style basis. What this means is that you're going to be first in on a construction and funds will be released to you based on what you've completed on site. Has anyone here gone through a reimbursement style construction budget before?
No.
Not a problem. The simplest scenario that I can give as an example is prior to closing, you're going to submit a construction budget to your lender. They're going to review it and they're going to approve it to make sure that based on what you ideally think needs to go into the property, those funds will be enough to complete it to the grade that you are going to need it to be. And the reason I say grade is because when you are renovating for making a rental property, you're going to use certain types of finishes. If you're renovating to sell, you're going to use different types of finishes. So let's say on that construction budget, you had $10,000 for new flooring and you had $4,000 for cabinets. Well, you're going to complete what's called a draw schedule. It's your estimated time that you're going to complete each line item. Let's say that we go to closing and about a week or two later, Conor, I need to get a draw. I need to pay my people. I've put money into this property. Well, we get there, we inspect the property, and let's say that the flooring, it's 50% done. 50% of it is down, it's on the ground. the other half sitting in boxes in the corner. We at WCP would release 50% of that $10,000 line item. So you'd get $5,000 for completing what you've completed thus far. Now your cabinets. Let's say that was supposed to be in the last draw that you were going to do. However, your contractor was able to get things in early and he put the cabinets up. That's not a problem because it's released based on what you've completed. That was a $4,000 line item. We'd get you that $4,000. So when you're evaluating deals, and we'll get into this later, not only do you have to have enough funds to close on the deal, that bottom line number, but you have to make sure that you have enough funds to start construction as well and pay your contractor. Unless you're able to work out a deal with your contractor where they start construction to X amount and you'll reimburse them later. Hard money lenders typically charge interest on an interest-only basis. So as I mentioned previously, you're not paying any of the principal. However, two terms I would like everyone to walk out of here with having a strong understanding of is the term Dutch and accrual. Dutch interest means that you're being charged on the whole loan amount. So if we had a loan amount of 100 grand and 50 of that was construction, well, remember, we're reimbursement style. That means you're not getting the 50 grand construction day one. So that means that there's only 50 grand been released to you. In a Dutch loan, you're being charged interest on the 100 grand. On an accrual-based loan, you're only being charged on the 50 grand that was released day one for the purchase and not the 50 grand construction that's been held back. 2 weeks later after closing, you receive a 25K draw from that 50K construction budget. Interest on an accrual-based loan is now charged on 75K, not the additional construction funds that's still remaining in your construction escrow. Any questions on this? This is something that someone should ask every lender they talk to. How do you charge interest? Is it Dutch or accrual?
I have a question.
Absolutely.
So I was under the assumption that with a hard money lender, if, like, for example, this is my first, I plan on purchasing my first rental property. And I was told if I don't have the 20%, maybe I should look into hard money lending. Mm-hmm. So you mentioned something about 80-20, which is what most conventional banks offer.
So you're looking to purchase just go straight into a rental property?
Yes.
So right now we're focusing on bridge loans.
Okay.
That typically need, fix and flip, that need construction.
Yeah.
Yep. We will have a whole other topic this year on rental properties, and okay. Todd will likely be leading that along with help by myself because I do offer 30-year financing for rentals as well.
Okay, so this is more for like flip it.
Yep.
Flip. Okay.
Yep, most of the fix and flip stuff. Absolutely.
Hey, Conor, can I jump in for a sec?
Yeah.
I'm sorry. Who was the young woman that just asked that question about rental properties?
Sherelle Jackson.
Hi, Sherelle. My name is Todd. I work with Conor here at Grid.
Hi.
I want to make sure I'm understanding your question. Are you looking to buy a shell, renovate it, and hold it? Is that your goal?
Yes.
Oh, okay.
Okay.
Perfect.
Yeah. I assume so. Conor, do you want to answer it or do you want me to take it?
So Sherelle, you would actually need two different closings. You would work with myself first, and you would get the acquisition and the construction financing.
Okay.
Right? Unless you're able to purchase all cash for the purchase price and the construction cost. So you would go through exactly what we're going through right now, and you would renovate that property to the rental grade standard. Mm-hmm. Upon completion and renting that property and getting a lease signed, you would then either turn to myself or someone or another lender to hopefully cash out refinance, follow that BRRRR method, or just refinance into a lower rate loan to hold it as a rental.
Yeah. Yeah.
So it's two separate transactions for you.
Yeah. So I do understand that, but that's where I was trying to understand like how it would work for me if because I don't have the 20% to start.
So we need to figure out what deals do work for you, and that's something that we can do offline.
Okay.
We work backwards.
Okay,
Yep, we
that's
can
why I
just-
gave you my information
Yep, we'll get creative with it.
where I'm supposed to be.
Yeah,
Okay.
and just quickly, Cheryl, because what you're looking to do, it's my whole business model. I've done it
Yep.
17 successful times in the middle of my 18th. My biggest issue when I started was I didn't have the 25% purchase price plus the first offer of the contractor. It's very tough for me to get going.
Exactly.
And I've gotten creative. I borrowed money from friends. I beg contractors to work with me. There's a lot of things you can do. But I would not have the portfolio today if I did not have a lender, a hard money lender, to help me through it.
Yes.
So
Yeah.
two separate conversations, but if you understand this piece of it, you'll be light years ahead whenever you're ready to go.
Yep.
Okay.
All right.
Perfect.
Sorry, Connor, go ahead.
No, perfect. Any other questions? I think Marcus, you had a question, right?
No, you guys answered it already. Thank you.
Awesome. It means we're doing well.
Thank you.
All right. How to prepare to work with a hard money lender. The reason I included this one in there is because I talk to a lot of individuals, right? And what I found is that there's a lot of people that do want to do deals. Last night, I hosted another grid event down in Northern Virginia on how to get started in real estate. And there's a lot of people that are very interested. However, I can always tell when someone is very motivated to do this because they have a couple things already ready to go when I ask these questions. So you're going to want to prepare your personal and your entity documents. Ask the lender, hey, what do you typically collect? Put those together, hold those in a folder for yourself. Like I mentioned earlier, if you don't have an entity yet, look at creating one so you can have one ready to go. Understand your budget. This goes to Sherelle's question about not having the 20%. Well, 20% of what? We need to evaluate what numbers are we actually looking at. Most lenders can work backwards based on what your current liquidity level is. And if not, hopefully they or myself can give some creative ideas to understand what your budget is. And as I mentioned, budget is not just about the purchase price. It's about starting the construction costs as well. Be realistic about your expectations for the deal. Not everyone is going to be able to, make $100,000 on their first deal. However, it's highly likely that someone can make 10 to 20% ROI on a deal, and maybe that transaction only took them 3 to 4 months. You do that 2 to 3, 4 times a year, you'll make your $100,000. So looking at the numbers of your deal and having a true realistic expectation is the biggest piece of it. That expectation also really helps to eliminate what's called analysis paralysis. Has anyone ever heard of that? Not a worry. Analysis paralysis is over evaluating a deal and making sure the numbers work to the penny and not being able to pull the trigger on a deal. That's one of the biggest causes I've seen of people not investing in real estate. We can underwrite a deal as best as we can, whether that's on the lender side or the client side. However, it's real estate. There's always going to be something that goes awry. We just have to make sure that you're going to build in enough of a buffer on the sales price or the refinance price or the construction budget to ensure that if a mistake happens, we can make up for that. Being very targeted with your deals when you're starting out and making sure to not get in over your head on a construction project. Personally, anyone that's brand new, I recommend that your first 3 deals are probably no higher than about 50 or 60 grand construction budgets. You don't really want to be moving a ton of walls and doing, structural work in your first couple of deals. And I've always pegged 3 as that number because what you're doing in those first 3 deals is working through your systems and your processes. You're understanding how to work with your particular contractor or finding a new contractor, how to correctly pull permits, what the prices of things should or shouldn't be. The experience that you gain in those first 3 deals can catapult you to 5, 10, 15 deals very, very quickly, as long as you're making sure that you're going through the process appropriately and you have people behind you that want to make sure you're successful and that the deal will not go south. Work with a lender to have an idea of what the metrics are that you can receive. Most of us are asset-based lenders, so the deal itself is going to say, hey, this is what we can offer you. However, any good loan officer should be able to say, based on your criteria and where you're going to be looking for deals, this is about what you can expect for a loan amount and an interest rate. Really tell them what your experience is within real estate. Are you an agent that has sold 200 homes, but you've never invested? That's someone that a lender wants to work with. Or I'm married to a GC and they're going to do all the work at cost. Those are really, really big things. Make an offer and tell your lender that you're making an offer on the property. The reason I say that's very important is because this allows the lender to help you win the deal. I often talk to realtors who have received an offer from one of my clients, and I can tell the realtor with truth that I've already priced it out for the client, and they have an idea of what the down payment and the loan amount is going to be. That gives an agent a sense of relief that this is already almost pre-approved. And one more item that I have, I didn't get a chance to put in here, is why use a lender? It depends on where you are in your career. Now, for people that are just starting out, the reason that people use a hard money lender is because of the lack of liquidity. You need to find a way to get started. We're very willing to take a chance on someone who's never done a deal because it's the asset itself that's most important to us. However, if you go to a bank to do a commercial loan, because this is commercial financing, because it's through entities, it's very hard to do that unless you have an extremely high credit score or high liquidity, because they're going to require more down. Their underwriting practices are just more stringent. Like I said earlier, we fill that gap of not knowing that wealthy uncle. I always call him Uncle Tony, and I imagine him with a gold necklace and a tracksuit on. But if you don't know someone like that, that's where that hard money lender comes in. And then as you grow, you use a hard money lender for scalability. It's called OPM, other people's money. You never want to use all of your money to get into a deal because it doesn't allow you to do other deals. Cost of capital. So those are the big reasons why individuals use a hard money lender. And I know this was a short one, but does anyone have any questions about what we went over thus far? Anything in particular they want to talk about?
I'm sorry, it's me again, Sherelle. So I do have a question. So with a regular conventional loan, you get pre-approved. How do I know how much money I can spend? Like, I know that you do it differently. So how does this work? So I already looking at a property that I want to purchase. So now how do I go about getting pre-approved or whatever the next step is?
So there's two things that are happening here. Now with hard money lenders, someone may say you're pre-approved. However, it's not true.
Yeah.
And the reason being is because it's about the asset itself. What happens if there's major title work issues, or if the appraisal comes back lower, or if your credit score that we haven't pulled yet comes back, you said, I'm just gonna make numbers up. Let's say you said it was a 740, but it came back at a 550.
Mm-hmm.
So the pre-approval that someone says like, hey, you're pre-approved for this isn't really true, because everything is looked at on an individual basis. Now, how I work as a loan officer is I have a conversation with you and I ask, how liquid are you? What are you willing to invest in real estate? And based off of that number, I can back in to where the purchase price and construction cost roughly should be based on the criteria that you've told me. The other question I would ask, and Todd brought up this point, is raising money. Let's say that you're really interested in purchase prices of, I don't know, 600 grand, but you only have 40K of liquidity. Those numbers just don't add up. But you're able to go raise 150, 200K from friends and family. That would allow you to get into those 600K purchase price deals.
Mhm.
But the other train of thought would be if you can raise that much, you can probably do 2 to 3 deals at a lower purchase price. And we would go over that together. So
Okay.
the pre-approval process is more about, like I was saying, the being realistic. Here's what we have and here's how we would make it work. Not here's a letter. You have a line of credit for $1 million. I write proof of funds letter on a per property basis. And that
Okay.
allows me to give you terms every single time when you're making an offer to an agent on a property or an off market deal. You
Mhm.
know roughly where you're going to have to bring to closing, because I'm going to give you what the estimated down payment plus closing costs are going to be. Additionally,
Okay.
starting out, I'm another set of eyes for you because I have to approve the deal. I have to make sure that I'm comfortable lending on this deal. So I'm going to underwrite every single deal as if I already have it ready to go. I'm going to give you what I think the ARV is if we agree. If we disagree, why? Let's talk about that. Or if I think it's so drastically different, hey, here's where I'm underwriting it at, and here's why. If it comes back at this number, here's where our loan amount is going to be. If it comes back higher on the appraisal, here's what we would be able to do.
Okay. I have your information, so I'll be going to the website.
Awesome. How do Mark asked a good question. How do hard money interest rates compare to commercial lender interest rates? Assuming you're talking, like a credit union or a bank, located in Philadelphia, we're going to be a higher rate, typically at least. And the reason being is because we move it a lot faster. We typically have a higher leverage than most banks, and it's less red tape. That's 3 of the major things that you're paying for. However, when you run it on a dollar for dollar basis, if we're talking, loan amounts under 700 grand, typically it's not that much different in terms of total payments, total holding costs, depending on the deal size. Once you get over $1 million on the loan amount and construction, like that's really where it makes a big difference. But speed is what's most important in our industry, in our little niche of it. So closing, 5 to 7 days to win the deal is huge. Having your construction draw released to you in 5 days is really big, so you can keep the project going. Most banks typically take at least 2 to 3 weeks, maybe even more, to get you a construction draw. And they also require what's called a title bring down. So when you receive a draw from a bank, they also have to pull title work every single time, which costs money, to make sure there's no liens on the property. That's not something that we do. We want to get you your money as quickly as possible so you can get through the property as quickly as possible.
Hey, how many points you guys usually charge?
Generally anywhere from 2 to 3 points.
Okay, thank you.
A couple of things that you'll want to ask hard money lenders when you're interviewing them is, do you have prepayment penalties? There are going to be some lenders out there that have a set amount of time that the funds need to be released. They need to be out there, maybe 3, maybe 6 months. Luckily, we have no prepayment penalties, so you can pay off quickly. What type of fees do they have? Do they have an underwriting fee, a doc creation fee? Do they have draw fees? What junk fees do they have? You want to see those things because those are costs that you need to incur. How do you release your construction draws? How do you charge interest? Do you have Dutch and accrual? Do you charge on a monthly basis or a per diem basis? Those are some of the major things that you'll want to ask.
Perfect, thank you.
Not a
Excellent,
problem.
excellent information.
Any other questions, guys? It's we got an extra hour here. I'd love to stay and network and help anyone out here that may have any other questions. All right. Did everyone get a chance to put their information in the chat? Antonella, did you get a chance to learn a little bit more info here for your client?
Yes, thank you.
Not a problem. Awesome. Glad to hear that.
Connor, I don't want to, rain on your parade. I don't think that's maybe not the right term, but I don't want to, market myself under this is Steve at Market Pro. So, I don't, this is your day, not my day. So,
Go ahead.
but we work with, we're a wholesaler who works in the Market Pro, and I'm Steve, and we work in the DMV, District, Maryland, and Virginia. And also I do the dispositions, the sales of our wholesale properties in Pennsylvania. And I can just say, vouch for our company that works with Conor on many, many deals, that he has the best rates in town among among hard money lenders. And, his customer service is excellent, which is why he's like a VIP for Market Pro. And, so that's just my 2 cents. He did not canvass me to come on this call. I'm trying to get, I'm, here to, learn all aspects of the process. I had 20 properties on my own behalf in Baltimore. And so, I know the market well.
Yeah, so Steve works, as he said, like with Market Pro Homes, probably marketing between DC area and Philadelphia, probably about 60 properties a month. So if you're looking for properties, whether it's down in Mid-Atlantic or in Philadelphia, please connect with him, give him your information. They're always putting out deals. I can vouch for them. I have worked with Market Pro for about 6 years now. And they're always willing to work with new investors and talk through a property about why it may need the construction that it needs. So that's someone that's invaluable to have on your side as a new investor.
Sorry, go ahead, whoever's speaking, sorry.
No, that's fine, go ahead.
I was going to say, what was his name? I don't see it in the chat, in his information.
Oh, my name is Steve Adelson, and the company is Market Pro Home Buyers.
Okay.
Can you put your information in the chat, Steve?
Sure, if I can figure out how to do. I'm good at real estate. The rest I'm a little shaky on, but I'll do my best to do so.
Conor, if I may piggyback off of Steve's point, this is Todd Miller. As I mentioned, I own 18 rental properties now, and I've worked with 4 different hard money lenders. I've worked with 12 or 13 banks and institutions to do my refis. Conor and I have done, I want to say 5 refis together. And I have been very impressed, not just with their pricing, because pricing is important, of course, but their ability to have a conversation. And that is the point I would like to stress as a 7-year investor at this point, is don't get 100% focused on the money. And look, I beat Conor up a lot on his fees, don't get me wrong, but they listen, they will understand your point especially because they're not in Philly and most of us are. And I'm like, look, I understand that the numbers might say this, but this is why this is a little better or maybe a little worse. And I found it to be very easy. So I appreciate them. And I didn't know Market Pro was on the call. I bought a deal from Market Pro in January of 2020. So good to finally meet you guys verbally.
Yeah. I've been with the company about, I guess going on 7 months now. So it was a little bit before my time, but the same people that were there when you, got your purchase are certainly still going strong now.
Yeah, I was shaken pretty heavily by Marlo. She was awesome. I loved working with her.
Oh yeah, yes. Marlo's actually focusing. So Marlo wore 2 hats, which was the acquisition, the buying of properties, and the disposition, which is what I do now, focus on the selling of properties. So she is focusing on acquiring both in the Pennsylvania and the our new market that we're opening up, which is in Florida. But I want to, this is not about me today, even though I appreciate
No,
it.
this is the point of it. We're networking. People need deals. I got to meet individuals like yourself.
And Conor, if you don't mind putting my name, cell phone number, and email in the chat, Cheryl or anybody, if you have questions about I'm buying my, especially in Philly. That's where I live and where I rent, or where my rentals are. Like, happy to help you with your underwriting. I will challenge your numbers to try to help you. Can't help you too much on the contractor side, but I can help review a bid with you. Like, anything you need. I love people who want to be landlords. So please reach out.
Okay, thank you.
Of course.
There it is.
Yeah.
All right. If that's it, guys, we'll let everyone wrap up. I'll stick around for a little bit more if anyone has any additional questions, but we'll give everyone back about an hour today.
Thank you so much.
Thank you so much. Look forward, Conor, to your next one. Thanks.
Thank you, guys.
Yeah. Thanks, Connor. And again, if anybody, is looking for properties on a wholesale basis, we're happy to help any way we can, even if it's just informational. It's fine. We're always looking to expand our buyers list and our partners, and that means that it's not all about the sale. It's about creating win-win situations for everybody, and that's the best way to grow any business.
Steve, I know I owe you a text, so it'll come tonight.
Do you owe me a text?
I do.
You do? Okay. Okay. Is that to cut me off of any?
No. So it's separate.
Okay. All right. Take care, guys. If
Thank you,
anybody's
guys.
there. All right. Thanks.
You too. Bye-bye.